The normal way people invest in startups is equity. And so in this chart again, this is exactly the same format as before. It's a very strange transaction. So you hand them some money and they hand you back some paper. And later you'll find out whether that's wallpaper or dollar bills. You don't know at this point. Because sometime in the future, an unknown amount of time in the future, hopefully, if all goes right, then someone else will buy this company, and then you'll find out how much that you earn back. It depends on what percentage that you negotiated, and we'll do valuations in about 10 minutes now. And so there's really no promises here, except that you're going to get a piece of the upside, whatever that is later. And so this is basically the analysis piece. So unknown amount of time, unknown amount of money in the future. But a hope that it's a large amount of money, that this company has scaled to a size that it's worth way more than you're buying now. So what are the terms? Despite all that uncertainty, there are normal terms for these kind of deals. And they are the most common way to invest in startups at scale. And so again, we have that first term, which is how much money are they raising? And is it all at once or is it tranched again? In this case, usually it's all at once. It's usually between 12 and 18 months worth of time to this company. They give you a budget, they give you a financial model. That financial model is hopefully 3 years or 5 years into the future, but you're just focusing when it comes to negotiating this round of equity, whatever round this is, you're just looking a year into the future and maybe 15 months. And if you really love the team, maybe 18 months. And you're seeing what they say they can do with this money over that time period. How much bigger is the company going to be? What hurdles are they going to knock down with the money? What equipment are they going to buy? Where will this company be and what might it be valued at that point? And so that's how much money you give them. If they're asking you, and it does show up sometimes with first-time entrepreneurs, they may say, we need $1 million for the next 3 years. Your question back to them is, okay, that's nice, but what do you need for next year? Let's just focus on 1 year at a time. And so really, when I say it's usually all at once, that's true per round, but usually there are a bunch of rounds in a startup before it is profitable. Our African fledglings are kind of rare in that case, that most of them are already profitable. But they want to be a lot bigger. So when we talk about investing in fledgling companies, we think about what hurdles can we get them through this year? And if they succeed at that or come close, how much more are they going to need next year to get through the next hurdles? What are those next hurdles? And then what are they going to need the year after that to grow further? And hopefully each time we do that, they stay profitable. That just means that we don't have to worry about them running out of money. But it doesn't mean that they run out of opportunity size, or they run out of aspiration, or they run out of ambition. Right? We can help them get bigger by providing them capital as equity. All right, now on the right side, the simple first question is, are we buying common shares or preferred shares? And so common shares are the shares that the founders created when they created the company. And preferred shares, the answer is almost always preferred shares. Preferred shares are the shares that the investors are buying. And so it's a different class of shares, we say. That's the term here. And the reason why they're a separate class of shares is because we're going to throw on a lot of preferences. And that's what makes them preferred shares. And it's not exactly the same as preferred shares in the public markets. Preferred shares in the public markets are actually a little bit more like debt. They have some other preferences on them. And I'm going to go through what these preferences are in a second. So usually the answer is we're going to buy preferred shares. And then that's an easy one. And then the hard one is, well, how much are we paying? So what are we paying per share? How many shares exactly were we buying? How many shares are there in the company? That's usually an invisible thing. They're usually not showing you that. If you see that in a first-time pitch deck, they've never raised money before. Even if you see it in the second-time pitch deck, the second meeting in the due diligence session, there's rarely ever we call it a cap table visible in their pitch deck. Something you have to ask for. So how do you figure out how much the company's worth, which is then helping you figure out how much you're paying per share and all that? And I'll show you that in a few minutes here. First, we'll get through the preferences. So you're buying some shares in a company. You really like the team. You think they're going to succeed. You think their timing is right, and they're lucky people, right? All the things we talked about in weeks past. Well, you're going to buy shares. What else do you want? What else do you need along with that ownership that makes you feel satisfied in making this investment? And so you can think of this as the separation between the ownership piece, as in the rights to future earnings and the rights to that upside when the company gets purchased, and the control that you want over the company to make sure that they're properly using your money. I think that's the best way to say it, and properly managing the company. So the number one preference, the most common thing out there, is a board seat. And it's not actually a board seat. What's normal is that in any given round, and these days we're kind of calling them, we used to call them just Series A, Series B, Series C, Series D. These days it's usually Series Seed is the first round from angels, and we're saving the letter A for the first round from venture capitalists. It's not 100% that way, but that's the way I've been telling the entrepreneurs to do it, and the way I'm seeing other companies do it. So Series Seed is usually a bunch of angels. And so when there's a round from Series Seed, that group of investors collectively will have a preference that says they have the right to appoint a member to the board of directors who represents the Series Seed investors. And then when the Series A investors come along, they ask in their stock purchase agreement for the right to appoint a board member representing the Series A investors. And if it's a really big round, if we're talking like the tech world, and that Series A is $15 million, then maybe two seats, right? One for each of the two venture capitalists. They tend to invest in pairs. And so it's the right to appoint someone. It's not the right for you specifically to be on the board of directors or your friend who's investing with you, but to collectively that group to pick someone to sit on that board. Right? And it may be you and it may be your friend, but it doesn't have to be. And then the board of directors, they exist because they have control over certain parts of the operations of the company, certain major decisions. They have the right to say yes or no. And so let's go back and really quickly talk about corporate structure.